With assets totaling over $3 trillion, Bank of America is the second largest bank in the US today.
Where it operates in 50 US states and also some international markets such as Europe, Asia, and Latin America. And it has actually 8 lines of businesses in 4 major business segments. So now let's have a quick look at what are the business segments that Bank America has. First thing is in consumer banking, where retail banking is for consumers like such as normal people like us, where we wanted to do some savings or maybe receive our money from our employers. And also preferred banking is for entrepreneurs or small business owners. And for global banking here are mainly for corporates or maybe big businesses. And for business banking, it is for small or mid-sized businesses where their annual revenue is about 5 million to 50 million. And global commercial is for mid-sized commercial, which is about 50 million to 2 billion of revenue. And this one is a bigger company where their annual revenue is about more than $2 billion. And for global wealth and investment management is to help those high net worth individuals to manage their money or help them to invest their money. And for global markets, it's actually for investing or trading activities such as invest in equities, commodities, or forex. So these are the 4 major segments of Bank of America. And we can see that almost 41% comes from consumer banking. Most of the revenue are actually coming from our normal day-to-day life, normal people. And their income source, they break it down into 2 types. One is the net interest income, and the other is the non-interest income. So we can see that the net interest income is taking the lion's share, which is about 55.3%. So now let's look at certain numbers. So the first one we will look at is their profitability metrics, which is their revenue. How much sales they are able to generate from their business activities. We will look into a 10-year trend. So we wanted to see the trend to be positive and consistent. And we can see that since 2012, the overall trend for Bank of America is actually going upwards, even though they are having some losses during the early days of the COVID pandemic, but then they managed to recover since then. And next, we will also look into their earnings per share. Their latest EPS is actually 3.21, which means that for every $1 that the investor purchased, the bank are able to generate about $3.21 of earnings. And the trend for this one is also in a consistent positive uptrend. How are they doing actually itself? So there are actually other financial metrics for us to evaluate a bank. So for tonight, we will look at loans to deposit ratio. So it means that how much of the deposits that the bank loan out to earn the interest income. The ideal LDR ratio will be 80 to 90%, which means that for every $1 that the bank receives, it will loans out about 80 cents to 90 cents. However, for Bank of America, their LDR is actually below the ideal, which is about 50 to 60% or 50 to 70%. So some people might think that the bank is a bit too conservative because they are not loaning out a lot of deposits to earn interest income. But in another way, if another person sees that, the bank is actually very conservative, it's not taking a very high risk to loan out most of the deposits out, but they are keeping some of the money back with them instead of giving out more borrowings. We will also look at their net interest margin. So here, it actually measures the differences between the income that is being generated by loaning out the money and also the interest expense that they have to pay to their depositors. Since 2012, it is actually slowly increasing. But then when COVID pandemic strikes, the net interest income actually drops. Since then, they have managed to slowly recover. We will also look into the liquidity ratio. How fast can the bank turn their current assets into cash to meet the depositors' request to withdraw their money? The higher the liquidity ratio means that easier for the bank to meet all these short-term obligations. So for Bank of America, it's about 120%. Other than liquidity ratio, there's also another ratio that the financial analysts will also look at, which is the capital adequacy ratio. So this actually measures the bank's financial ratio because capital for a bank is very important as it helps them to run their operations or even absorb losses. Because certain banks, when they invest in certain investment, they might encounter certain losses. So if they have a very strong balance sheet or has a lot of capital, they're able to absorb losses and it will not trigger a default of the bank. And usually for capital adequacy ratio, they will look into Common Equity Tier 1, which is CET1, the highest quality of the capital for the banks where they can fully absorb all the losses. For the big banks, the regulatory requirement for CET1 is more than 9.5%. And for Bank of America, based on their latest annual report, it is about 11.2%.